Hey guys, it's Adrian here, the Canadian in a t-shirt. And today, I'll be breaking down the US bank collapse with SVB and the lessons that we can learn from it as Canadians to protect our money. In the past week, we've seen the collapse of 3 banks in the US: Silvergate, Signature Bank, and the big one, SVB, Silicon Valley Bank. And it's caused a lot of fear and panic, both in the US and here in Canada. So I want to make this video to put your mind at ease. Don't worry, the Canadian banks are not going to collapse. It's a totally different situation up here, but there are still some critical lessons that we as Canadian investors can learn from, and that's what I want to focus on today. In this video, I'll start with a summary of what caused the collapse of SVB, and that will lead into the 3 main mistakes or lessons that us Canadians can learn from. These lessons are diversification, emergency savings, and how to protect yourself from bank failures. I'll also touch on why the Canadian banking sector is safer and insulated from the US. And as always, I include timestamps for each chapter, so feel free to skip ahead. So SVB, Silicon Valley Bank, was a large regional bank focused on tech companies and startups in California. In fact, they did business with nearly half of the tech startups and venture capitalists in the state, with assets worth over $200 billion. So it was a big deal, and it was all over in a matter of days because of a bank run. A bank run happens when customers are afraid that the bank might fail, so they panic and withdraw their money all at once. The bank doesn't have enough cash to handle those sudden withdrawals, so the panic grows and now more people want to withdraw, and pretty soon the bank is out of money, insolvent. That initial fear that the bank might be in trouble became a self-fulfilling prophecy that led to the second biggest bank failure in US history. It's important to understand that when you deposit money into a bank, your cash doesn't just sit there in a vault. Some of it does. Banks are required by law to maintain a certain level of cash on hand, or liquidity, to handle everyday transactions. But banks make their money by taking your money and investing it. This isn't a bad thing, it's a win-win. The bank earns a profit from investments, and your money is safe and secure when you need it. And it's not like SVB was gambling with risky speculative derivatives. They were actually investing quite conservatively with long-term treasury bonds. These are US government bonds, very stable, very boring. They provide a small but reliable source of income, and they're liquid. It's easy to sell to another bank, so bonds are perfect for customer deposits. And that's the first mistake we learned from: the importance of diversification. You never want to put all your eggs in one basket, even in something as safe as treasury bonds. We'll get back to lesson 1 later in the video, but here's what happened. Over the past several years, interest rates were super low. Borrowing was cheap, so money from startups and venture capitalists were flowing into SVB. These companies were new customers, depositing their money. So the bank took their money and invested heavily in treasury bonds, normally safe. But with rock bottom interest rates, these bonds only offered less than 2% interest. Then 2022 came and the Federal Reserve started aggressively raising interest rates. And when rates go up, bonds go down. If SVB holds a 10-year bond with 2% interest, now it's not worth as much. It's much harder to sell. Why would I buy that old bond with 2% interest when I can just buy a new bond from the government with 4% interest? That's exactly what happened. As interest rates jumped higher and higher, their bond investments plummeted in value. And normally, that would still be fine. They could just hold those bonds until they mature and get their money back. Unless they were forced to sell at the worst time, and that was their second mistake, and our second lesson: the importance of an emergency fund. It is so important to protect yourself with an emergency savings fund so that you are never forced to sell at a low point. More on that later, but let's continue the story. So interest rates were rising fast. Tech companies weren't able to borrow cheap money anymore, so instead of putting money into the bank, they started taking it out. Rumors started that SVB might have a problem with liquidity, causing more companies to withdraw their money. That became a vicious cycle. The more they withdrew, the more they panicked, depleting their cash reserves faster and faster. Eventually, the credit rating of SVB was downgraded. That's officially declaring that the bank is at risk, and all hell broke loose. Panic went through the roof. Everyone started withdrawing all their money. The bank run was in full force. In a single day, $42 billion was withdrawn. That's 25% of the bank's total customer deposits. The customers wanted their money back, but the bank didn't have the cash, so what could they do? They were forced to sell their bonds at the low point. They had to sell $21 billion worth of bonds at a huge loss of $1.8 billion. Almost $2 billion down the drain on safe investments. They bought high and were forced to sell low. They tried to make up for this loss by selling off shares of the company, another last resort. They tried selling $2 billion worth of their stock, but no one wanted to buy. It doesn't exactly give confidence to investors when a company is selling billions of their own stock out of desperation, so the stock plummeted even further. It was over. Within a day, the bank was shut down and taken over by the government. But the story doesn't end there. On the Friday, Silicon Valley Bank is shut down, dead. But most of their customers still don't have their money, and there's no way to withdraw it now. The bank is gone. Their money that they deposited is totally inaccessible. Thousands of businesses, each with hundreds of employees, can't access their money. They can't pay their employees. They can't pay their rent. They can't process any payments. These companies have essentially lost all of their money through no fault of their own. For a whole weekend, they can do nothing but hope and pray that the government will step in and save them. That leads us to our third lesson: protecting yourself from bank failures. In Canada, our money and investments are protected by the government to a certain extent, but you have to do it right, which I'll cover later in the video. In the US, your money in the bank is also protected by the FDIC, but only up to $250,000. For everyday people, that's pretty good, but for businesses, that's nothing. Over 95% of Silicon Valley Bank customers were above this threshold, meaning that their money was not insured. So if their bank fails, their money is gone and their company is dead through no fault of their own. That is terrifying. Thankfully, on Sunday, the FDIC announced that all customers will be made whole and they'll be able to access all of their money by Monday, even above the $250,000 threshold. This was a huge relief for thousands of businesses. The government stepped up and protected their money, but this was not guaranteed. Only $250,000 of their money was guaranteed to be protected. The rest, the vast majority of it, was at risk, just because they worked with the wrong bank. You never want to be in this situation, whether you are a business or an individual. So that's the story of the second largest bank collapse in US history. Mistakes were made across the board, but instead of freaking out and spreading panic, let's learn from these mistakes, starting with lesson number 1, diversification. I've said this hundreds of times on YouTube. You never want to put all your eggs in one basket. You never want to put all your money into one asset, one industry, or one stock. No one knows what will happen in the future, so the best way to protect yourself is to diversify. Spread out your money across multiple companies, multiple sectors, multiple countries, and multiple asset classes. Even if it's something safe and secure like bonds. Bonds can be great, especially as you approach retirement, but don't have your entire life savings in bonds. Look what happened to SVB. As the interest rates skyrocketed, their low-risk treasury bonds plummeted, costing them billions of dollars. Same with real estate. I love real estate investing through REITs, REIT ETFs, and physical rental properties, but I would never put all my money into one property. That's too much risk. Even more so with the stock market. Don't ever go all in on one single company. You guys know I love investing in TD and Ryokan, two of my all-time favorite stocks, and I've talked about them dozens of times. But would I go all in on these companies? No way. They are two of my largest holdings, but even so, they only make up a small fraction of my portfolio. Look here on my Blossom account, where you can see my entire investing portfolio totally for free. None of my holdings make up more than 8% of my portfolio because I am diversified. TD is a fantastic dividend growth stock. I have never sold it, and I plan to invest in it until the day I die. But even so, it only makes up 5.5% of my portfolio. So in the worst case scenario, if something cataclysmic happens and TD Bank goes out of business, I would only lose 5% of my money. Sure, it will hurt, but I'll be fine because the rest of my investments will survive. That's the power of diversification. No matter what is happening in the world, some sectors may go down, but others will go up. So your overall portfolio will be okay. Check out my videos on diversifying with ETFs and my favorite ETFs in Canada and the US to help get you started. And if you want to see all of the stocks and ETFs that I invest in, click my referral link down below to download the Blossom Social app. It's totally free and built for Canadian investors to build transparency and learn from each other. It's an awesome community that I am proud to be part of. Check out my Blossom announcement video if you're interested. On to lesson number 2, the importance of an emergency savings fund. This is absolutely vital. In fact, you shouldn't even think about investing until you have an emergency savings fund set up. I talked about this in detail in my video on how to build wealth in Canada. Investing was step number 4. Building an emergency fund was step number 3. And here's why. The unexpected will always happen. You can't avoid it. There will always be another emergency. Your car breaks down. Your furnace dies in the middle of winter. Your dog needs to go to the vet. These will happen, and you need to have money available right away to deal with it. If you don't, you'll fall into debt, rack up those credit card bills, and that's a hole that's very hard to climb out of. You may even be forced to sell your assets, and if the market is at a low point, that is a guaranteed way to lose a ton of money. That's exactly what happened with Silicon Valley Bank, and you never want to be in that position. Investing is all about freedom. You are putting money aside today, letting it grow and compound for years and years so that one day you can choose to take out that money and enjoy that profit. That's financial freedom, but it only works when you are in control and you can choose when to sell and withdraw your money. This emergency fund is not designed to make you rich. It's there as a shield to protect your investments so that whenever unexpected expenses come up, you can pay for it right away without putting your investments at risk. This emergency fund should be held in a high interest savings account so that the money is safe and guaranteed and always available at a moment's notice. It's not tied up in investments or locked up in a GIC. I recommend using EQ Bank. I've been using them for years since they have no fees and they offer the highest all-around savings rate in Canada with 2.5%. EQ Bank is my go-to savings account, so if you want to sign up, click my referral link down below and you'll help support my channel. Note that other banks may offer promotional interest rates that are even better, so shop around. Another favorite of mine is Simply Financial. Right now, they are offering a promotional rate of 5.25% on their savings account until May, which is great. I'll also include my referral link for Simply if you want to take advantage of this offer. And once that promotional rate ends, switch your money back to EQ to get 2.5%. That's what I do every few months when these promotional rates come around. Note that the majority of your money should be in investments. That's how you build wealth in the long run. You don't want to hold too much in savings since the small interest rate barely even keeps up with inflation. I suggest to hold enough cash in your emergency fund to cover all of your expenses for at least 4 months. That way, if you lose your job, you'll be able to stay afloat long enough to find a new job and get back on your feet. That works for me, but if you have kids and a family depending on you, you probably want to bump up this number to 6 months of savings, just to give your family extra peace of mind. Now for the third lesson, protecting your money from a bank failure. The big Canadian banks are incredibly resilient and well regulated. It's inconceivable that the Canadian banks would fall, but even so, you never want to be in a position where your money is at risk. Remember, with SVB, customers could have lost millions of dollars of their money because the government only insured $250,000 of it. The rest was at risk with no guarantees. In Canada, the government also insures our money and our investments, but there are limits, so you have to play it right to protect yourself. In fact, your savings and your investments are treated differently. Let's start with your savings. In Canada, our savings are protected under a federal corporation called CDIC, Canadian Deposit Insurance Corporation. CDIC protects your cash in a checking or a savings account as well as GICs. It does not protect investments at all, so no stocks, ETFs, mutual funds, those are covered by CIPF. I'll get there in just a minute. And it goes without saying, but crypto is not covered by anything. There are no regulations, so if you lose your money, you're on your own. The great thing about CDIC is that your cash and savings are protected by the government, even if your bank collapses, so you will not lose your money. The government has your back, and this is all done automatically. You don't have to apply for anything or fill out any forms. You don't even need to live in Canada or be a citizen or permanent resident. As long as your bank is registered with CDIC and they have this purple lock logo, your money is safe, up to $100,000. But here's the thing, you are protected for $100,000 with each institution. So if you have more than $100,000 in savings, split it up between multiple banks to ensure that all of your money is safe. Let's say I was saving $130,000 for a down payment on a house. I love EQ Bank, and I want to get that sweet 2.5% rate on the full amount. It's tempting, but it's not worth the risk. Again, this is incredibly unlikely, but if EQ Bank were to fail, I would only be protected up to $100K, so I would lose the remaining $30,000 through no fault of my own. That is devastating. So instead, I would hold $100K in EQ Bank and hold the remaining $30K in another bank like Simply. That way, all of my money is protected. Don't risk $30,000 just to earn an extra $100 of interest. Technically speaking, you can be insured for more than $100K within a single bank if you hold savings in multiple types of accounts. You'll be insured $100K on your regular savings, plus an extra $100K if you have a joint account, an extra $100K for a TFSA savings, $100K for RRSP savings, RESP, RDSP, etc., etc. However, I do not recommend holding savings in your TFSA and RRSP accounts. Those are meant for investing, not savings. If you hold savings in those tax-sheltered accounts, frankly, you are wasting that precious contribution room. I've talked about this in detail in my videos on TFSA and RRSP mistakes. So bottom line, if you have more than $100K in savings, split that money up between multiple banks to ensure it's all protected. And never put your money into a bank or credit union or any institution if they don't have that CDIC purple lock. Don't get seduced by sign-up offers or promotions. If they aren't insured, don't give them your money. So CDIC protects your savings, but in Canada, your investments are also protected by CIPF, the Canadian Investor Protection Fund. CIPF protects your investments like stocks, bonds, ETFs, mutual funds, and REITs. But again, no crypto. And these investments are protected up to $1 million, but it works a little different. With savings and CDIC, it's simple. If your bank fails, the government will give you your money in cash. But with investments, if your brokerage fails, CIPF will try to return your investments themselves. So if you owned 100 shares of Enbridge and your brokerage collapses, CIPF will try to give you those 100 shares. If those shares are missing and can't be returned, then CIPF will pay you cash, and you'll receive the market value of those shares on the day the brokerage became insolvent. Again, this protection is limited to $1 million, 4 different account types. Your investments in your TFSA and non-registered or margin accounts are insured up to $1 million. Your registered retirement accounts like the RSP, RIF, and LIRA are also insured for an additional $1 million. And if you have children, your RESP investments are also insured up to $1 million. So in total, you can protect up to $3 million worth of investments within a single institution. And if you own a corporation like a holding company, your corporate investment account is also insured for $1 million. You guys know that Questrade is my favorite broker in Canada. I've been investing with them for over 7 years, but if my TFSA portfolio grew to $1 million, I would stop adding money into Questrade and I'd move into another broker like Wealthsimple. Questrade has been around for over 20 years. They're not going to fail, but just to be safe, I want my money fully insured. So once I pass that 1 million threshold, I'll split my portfolio between 2 brokerages. Just make sure that whoever you invest with is covered by CIPF. If not, walk away. And if you guys want to start investing with Questrade, click my referral link down below, Canadian t-shirt, to get $50 in commission-free trade rebates for the first 30 days when you sign up. Plus, you'll help support my channel. I've said throughout this video that the Canadian banks are safe and insulated from the bank collapses in the US, and here's why. Canadian banks are some of the most secure and heavily regulated banks in the world, and that's a good thing. These regulations force the Canadian banks to keep more liquidity, to have more cash on hand. Regional banks like SVB had much looser restrictions. In fact, SVB pushed for further deregulations, and look what happened to them. Plus, the Canadian banks have a much more diversified client base. They serve people, small businesses, and large corporations. Banks like SVB were tailored towards tech startups in California, a very niche market. That made a bank run much more likely because their customers tended to move as one. There's a lot more to be said about Canadian banks versus US banks, but this video has already gone long enough, so I'll leave you with this fact. In the 2008 housing crash, we saw 465 US banks collapse within 4 years, but not a single Canadian bank closed down. In fact, we haven't seen a Canadian bank fail since 1996 in Calgary, and even then, it was a small bank with less than 3,000 customers. I hope that puts your mind at ease. It is important to pay attention to what's happening with the US banks, and we can learn some crucial lessons from their mistakes, but rest assured, the Canadian financial sector is strong and here to stay. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel here on YouTube, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook or Blossom at Canadian T-shirt, click the link in the box below or click the links on my homepage. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.